Welcome, everybody. This is David Bush coming at you from Overflowworks.com, and we are so excited that you've joined us for this webinar. This specific webinar is designed around the topic of improving your mortgage direct mail response rate, and we've got a special bonus section on how to improve your closing ratio. Now, this is going to be a high-level webinar, going to be focused specifically on those individuals or organizations that are spending a significant amount of money in lead generation, direct response marketing, and we're going to try to keep the conversation and the presentation to be at that high level because we know that you are looking for creative strategies. You want to get the very best practices and the newest practices and strategies that are working. So, for some of you that registered for the webinar, but direct mail and direct response marketing and lead generation has not been part of your marketing strategy, this will be an opportunity for you to listen in to what the major players are doing out there across the country and to hear from an expert in the area of direct mail marketing. I've got here with me Jeff Bush. Jeff is the president of Overflowworks. He's got over 20 years of direct marketing experience, and he's mailed over 1 billion pieces of direct mail for the mortgage industry. So he gets it, he's done it, and he's the master at it. And he's also been in the mortgage business back from 2000 to 2007. Jeff actually owned a mortgage banking company. They closed over 5,000 loans, and his passion's always been marketing, and so he exited the mortgage business and has mastered direct response marketing for mortgage clients that are significant in nature. We won't reveal their names, but they are some of the biggest players in the country, and it's a pleasure to have you on the webinar tonight, Jeff.
Yeah, thanks, Dave, for having me. Appreciate it.
Well, we've got this two-part webinar presentation. There's more people that are just trickling in, but Jeff, talk a little bit more about your background, just so that those people that don't know who you are can kind of get a feel for your background as a direct mail expert as well as your experience in the mortgage industry.
Sure. So spent about 15 years doing direct mail marketing for car dealers and mortgage companies around the country, and the company that I worked with actually sold to a big conglomerate and decided I wanted to get out of the direct mail industry and do something else. And I looked at all my mortgage clients and like, wow, these guys are making a lot of money off this direct mail that I'm doing. I think I'm going to start a mortgage company. So I'd never done it before, didn't know anything about it, but I knew how to make the phones ring with direct mail, which I knew was an important part of, building a mortgage company, funding a lot of loans. So started a little net branch and, been doing 10 or 20 loans a month, and then went off on my own and did the whole broker thing, DRE, CFL in California, and got up to doing around 60 loans a month, and then went out and got a $20 million warehouse line, opened an escrow company, and, next thing I know, I'm, funding 130, 140 loans a month as a banker and doing my own escrows, and real profitable, big company. I was spending, as much as $200,000 a month on direct mail to get, around 2,000 phone calls into the building to close, 140 loans. So spent 7 years in the mortgage business and licensed in a few states. So I really understand the mortgage business because I was in it. I understand loans and funding and conversion and calls and loan officers and licensing. So I kind of have a little bit of a unique experience that I'm a professional in direct mail, and I was a professional in the mortgage industry, so I feel like I've got a little more value to add to some of the mortgage clients out there trying to make this work in this crazy industry right now for, calls, leads, conversions, because I've been on both sides of it. So.
Yeah, and this is going to be an interactive webinar, and so if you'd like to ask Jeff a question, you can ask a specific question or a generic question, and we'll get to those questions in the order they're received. Jeff, before we jump into the agenda, the question that is trickled in here is that if you've been in the mortgage industry and you understand how
here it comes. Here it comes. I can hear it coming.
You hear the train coming. So share with the audience of just what has attracted you to stick into the direct mail business and to not stick in the mortgage business.
Well, I W-2'd myself for $2.2 million in 2005 out of my mortgage company, so I made a lot of money in the mortgage business, and it was very fun and exciting and lively. But when the crash came in 2007, warehouse lines and lenders going out of business. It was painful, and I went through a pretty tough time, like a lot of people in the mortgage business did, and just got really kind of tainted to how quickly that business changed. So I decided to go back to kind of my roots of direct marketing and build something that wasn't as up and down as the mortgage business. I mean, make $2 million one year and lose $2 million the next. It was just, it was stressful, and I didn't enjoy it as much as I enjoyed marketing, to be honest. So I just decided to kind of go back to something different. That's the honest truth. I loved the business, made a lot of money at it, but just decided to go, do something different.
Well, Jeff, you made a lot of money in the mortgage business doing niche-specific marketing, and we're going to talk about some of the niches that you're helping other mortgage lenders to really exploit right now and get the very best out of them, what's left or what's to come of them. Talk a little bit more about the niche strategies that you used and why you think that direct mail marketing is the key approach going forward in 2014.
Well, it's funny, if you go onto Craigslist and you you search for mortgage companies that are hiring loan officers right now, you'll notice that a lot of mortgage companies put right in their ad, we provide direct mail incoming call leads. And the reason they do that is because loan officers know the absolute best phone call they could take or lead they could take is not an internet lead or radio or telemarketing. It's live incoming direct mail calls. So they have the highest conversion. The loan officers, like the leads because they have a good ratio on their time and energy versus a closed loan. So I just really believe in direct mail, and there's other things that work. There's huge companies funding hundreds of loans a month off just internet leads, but I think direct mail should always be a mix, a part of somebody's marketing budget. Had a lot of success with it. Laser targeted loan amounts, loan types, zip codes. I mean, so many things we can do with it. So it's just a fun way to put into your mix of marketing.
Well, there's a lot more questions coming in, but I'm going to go ahead and move us into the agenda, and then I'll ask those questions based on the presentation today. But Jeff, you've got two major topics. One of them being successful mortgage direct mail, the strategies that you're doing, and some of the ones that you've created for some of your clients. And you've also got some content on improving your closing ratios and 7 specific things that participants can do to improve their closing ratios. Talk a little bit more about the direct mail marketing basics and how they apply to your strategy when you do direct mail, because we do have some big players on the phone, but talk about how you have interpreted these percentages.
Well, so all my reading and studies in direct marketing through the years tells me that 80% of the success of your direct mail campaign is going to come down to the list and the offer and how you blend those things together. Everyone knows a list is important, but it's actually not the only thing important. What offer you're making to that list of people, the combination of those two things together are 80% of your success of your direct mail campaign as far as response rates and conversions and overall cost per funded loan. Only 20% is based on the type of mailer you send. I mean, do I want to do a postcard, a letter, a snap pack? Do I want to use red or blue? So many people spend 80% of their time designing the letter, and that's not the most important part. It's the offer and how you present that offer and who you're presenting it to. So targeting that list and offer is just so crucial, and that's what we spend all of our time on, is writing copy, how I say it, and then who I'm saying it to. That's just the two most important things. So we try to do that blend of quantity of phone calls and then quality of phone calls. We can get a lot of calls, but if conversion's low, it's not really a successful marketing campaign. So that's really what we're going to talk about, is lists and offers, and most important part about making that phone ring and closing loans.
I'm going to throw a poll open here for just a moment. If everybody can come to their computer and cast their vote, I'll close that here in about 10 seconds. But just to give Jeff some feedback of who's on the line and what kind of level of volume you're doing, would everybody just go ahead and cast their vote? Jeff, you're going to launch this particular webinar presentation on a topic that most mortgage people are not going to believe is possible, and that's the area of purchase marketing with using direct mail. Talk a little bit more about why you decided to do direct mail for purchases and why it hasn't worked in the past but is now beginning to work.
Well, let's see. if anybody was in the mortgage business in 2007, they may remember, I was doing 140 loans a month, and then, my big lenders, IndyMac, Countrywide, Option One, New Century, were all going out of business and decided to stop buying loans off my warehouse line, and I went from funding 140 loans to 30 loans a month. It was crazy how fast it dropped. So, but purchase business never went away. I mean, people were still buying homes. So just to diversify some of these mortgage companies, it'd be great if you could, be doing some purchase loans. And when interest rates spiked a few months ago, I mean, I have like 100 mortgage clients around the country mailing with me, and they all freaked out, called me, we got to find a way to do purchase loans because rates just went from 3.5 to 4.5, and everybody went through a lot of pain. I mean, some mortgage companies closed down in the last few months because they weren't diversified. So I like having a mix, and so I started doing some purchase mailers. They take longer. I mean, you've got to get the phone call, qualify them, go find a house, 60-day escrow. So you're talking about 90-day turn times from the time you pay for the mailer till you're funding loans. But I think it's an important part of a mortgage company to be diversified so they don't, go out of business when rates go up a point, or if a program goes away, they were so leaned in one area. So I've been doing these purchase mailers. The bankruptcy back to work program came out, and a lot of people that went bankrupt 12 to 36 months ago are back in the market to buy homes. Some of them back to work, some of them just regular FHA, VA purchase loans. It's interesting. My mortgage clients that are doing purchase mailers with me, they're like, it's taken a while to get these things funded, but we've got some, $250,000, $350,000, $400,000, purchase loans where 100% VA, 97.5% FHA. These are monster loan amounts. I mean, our average refi loan amount around the nation might be $180,000, whereas a purchase might be $360,000. So the loan amounts are twice the size. You can spend a little bit more money marketing, and if you can wait 90 days to fund loans, if you have the cash flow to do that, I'm pretty excited about the responses I'm getting on the purchase mailers and diversifying some of my clients into not being 90% refi mortgage shop. So refis are easier, faster, make more money, but it's nice to have a little something else going on.
Well, you definitely have some data that is, you said 40% of the equation, and the offer's pretty strong with the Back to Work program. What's the cost per funded loan on some purchase marketing just based on what you've seen so far?
I say my cost per funded loan in direct mail marketing for a refi is anywhere from $500 to about $1,200. We probably come in around $900 a loan. To get a $200,000 loan funded, call it $900 in marketing. The purchase campaign, the last 5 I did, I'm going to say they probably came in around $1,200 per funded loan in marketing costs. But again, the loans were twice the size, and now some of my mortgage clients have gotten smart asking these realtors to help pay for the campaign. I mean, these guys are sending 4 or 5 buyers to these realtors. These realtors are making 3% commission. The loan guys are making 2.5% commission, so why not have the realtor help pay for these mailers? So now we've got ways to offset some of the costs, which I'm pretty excited about.
Well, you've also got some FHA conversion marketing that you're doing. I mean, talk a little bit more about the letter that we're showing on the screen right now. Bring that up, and then a little bit more about the list strategy that you've used to generate the high quality of leads.
Yeah, so this has been a popular letter over the last few months. FHA purchase people who bought a home 1 to 4 years ago, equities come way up in a lot of areas around the country. So if I've got an FHA loan and I'm paying 5.5% interest rate and I took it out in 2011, if I've got 20% equity in my property now, let's refinance them out of their FHA loan into a conventional and get rid of their mortgage insurance altogether. You might save these people $150 to $400 a month just getting them out of their MI, and then lower their rate from 5.5 to 4.5, 4.25. There's a lot of savings there. There's a lot of benefit. So this mailer shows their loan amount, what they're currently paying based on their rate. It shows them the actual mortgage insurance amount that they're paying based on what the MI factor was in that month and year that they're loan funded. So we total up their payment. On this one, the person's paying $1,900 a month. If they refi today down to $1,400 a month, you're going to save $500 a month, $6,000 a year. So this letter's been really effective, just really targeting the data to people paying high rates, high MI with equity. The equity position is tough to calculate perfect around the country. In some areas it's been a lot more successful than others. Any place where equities come up 10, 15% over the last 12 months, but this has been a big success, taking these FHA borrowers into conventional loans.
What about HARP? Jeff, you've done some stuff with non-owner occupied HARP. Is there any other strategies that you're seeing that are really pulling a good response rate at this point?
Well, when we first started mailing for HARP in April of last year, we'd mail 10,000 letters, and I mean, I had guys getting 200 phone calls, 2% response. And then, 3-4 months later, it dropped to 100 calls and then 50 calls. And right now, around the nation, 10,000-piece HARP mailer, probably only going to generate 30 to 40 phone calls, 0.3 to 0.4 response rate, which could take your cost per funded loan from, $900 up to $2,000, which doesn't work. So we found some little niches within HARP, like, people who funded their loans in May of 2009 that didn't qualify before but qualify with the new program. We've been mailing non-owner occupied mortgages that fit the HARP guidelines, Fannie, Freddie, prior to June 1st of 2009. And so we hit these little data pockets, and we can jump response rates back up to, say, 1% instead of, 0.3. So with these data sets and the way we tweak all this data, we're still able to get a pretty good response rate on HARP, but you got to be open to having all these different products. Like the non-owner is not something that everyone has available, unlimited LTV, but there's little pockets of data still out there that haven't been saturated. 6 months from now, they will be saturated and it'll be over with. So these mortgage niches tend to run for about 6 months, and then it just becomes not profitable to mail anymore. So we're always looking for new data sets, new letters, new ways to write the offer to attract a different audience and, keep that response rate up and cost per funded loan, marketing costs down.
Well, you said, Jeff, that $500 to $1,200 per funded loan was the range. Is there any more specifics on particular types of mortgages, like government loans versus HARP versus traditional refis?
That's a great question. Depending on what area of the country you're in and how much data there is, and for certain size loan amounts, all of that can vary. I'd probably set up a conference call with someone and look at the states they're licensed in, pull all the data, FHA, HARP, VA, and just look at it all and be able to quote them a more accurate response rate depending on the state. I mean, if you make 3.5 points on an FHA loan and you only make 2 points on HARP, you could obviously get half as many phone calls on FHA and make the same amount of money. So those are all different things to look at, is revenue per loan, which loans are you guys good at and competitive on with rate. So there's a lot of different things to look at with not just the calls, the conversion. I had a lot of clients that were splitting their mailings, doing half HARP and half FHA and mailing 5, 10, 20,000 pieces. And at the end of the day, it was averaging out the same, around $900 a loan. Sometimes FHA would go up, and then the next month HARP would be a little better. So both of those things were pretty similar from what I've seen over the last year of mailing.
Great. Well, we've got another one up here for VA loans. How successful has VA marketing been for you?
VA streamlines, I mean, it got pretty saturated. Again, you start out mailing 10,000 letters and getting, 80 phone calls, and right now we might be down to 40 because it's a little more saturated. But if you get 40, calls from VA, they're pretty easy loans to do with streamlines and no appraisal. So, if you fund 5 or 6, decent loan amount VA loans, you can still make $20,000 or $30,000 on a $6,000 mailer. So it's still profitable. It's come down, but we're still making it work. And believe it or not, just over the last few months, a lot of big mortgage companies pulled out and stopped mailing or literally closed down. So believe it or not, like today, there's not as much saturation on mail as there was 3-4 months ago, just because of the turmoil everybody just went through. So
I'm going to throw another poll up, Jeff, just in terms of marketing budgets, just to kind of get an idea of where people are at. But just a question from the audience was, is that if you had to test out a mailer, which one would you suggest if you wanted to fund 10 loans, and how much would it cost?
So if you want to fund 10 loans, maybe we look at like a 20,000 piece mailer for 10 grand. And what I would do is I'd split it in half and do like half FHA/VA and half HARP. And within those data sets, we'd go after some non-owner occupied HARP, some owner occupied, different date ranges, different loan amounts. So I'd probably test 2 different letters and 2 different data sets and send out that test. And then you be the judge, so figure out which one got the most phone calls, but more importantly, which one converted the most loans, the biggest loan amounts that I made the most amount of money on. It's not just about the calls, obviously. It's the size of the loan and what the conversion is. And I like testing out a couple different mailers, send them both out, and you be the judge, because sometimes one month it's this direction, and the next month it completely can flip-flop on us. And we have a basic idea of response and conversion, but it does change pretty rapidly out there with what's going on in the news, the media, how many people are out there mailing, saturation levels. So I call it my mutual fund mailer. I like to diversify and not have all my money in one thing. Let's do a couple different ones just to, spread out the risk a little bit.
Great. Well, I'm going to close the poll up here in about 5 seconds. We have this color version of a letter that you've done for one of your clients, and that had a good response rate, and it was around mortgage insurance. So I'll show that here in just a moment. If everybody can go ahead and cast their vote, I'll close the poll here in just a second or two. What about color, Jeff? I mean, what's the cost increase for throwing some color on a mailer?
Color really hard cost is about 6 cents more for any mail house. So, on 100,000 pieces, it's $6,000 more for color. If you plan to sell your mortgage company for millions of dollars over the next few years, maybe you want to use color in your logo and trying to brand, but direct mail is pretty expensive to try to brand your company. You might be better off on television. So I don't really like the color too much for the extra money. It usually does not increase the response at all. So it's really more about a branding issue and getting your name out there and your logo. If you want to sell the company or become a national brand, then it becomes a little more important. But some people like it. It does look nicer, a little bit more professional. So yeah, color mailers, obviously we can do color, black and white, but it doesn't really increase the response. It just looks a little nicer and a little bit better branding. This particular mailer's got a lot of variable data in it. I like variable data. It really lifts my response rates. I want to talk about their loan amount, their payment, their mortgage insurance, and show them, the offer on mortgage direct mail is all about, for refinance anyways, how much money are you going to save me? Show me the number in dollars, and that's what makes the phones ring. So, your current payment's $2 grand a month. We can get you down to $1,600. Hey, $400 a month savings sounds great, but $4,800 a year sounds even better. Multiply it times 12 months. Talk about their mortgage insurance. Give them a cash out offer. We've been putting on some of these mailers, whatever their loan amount is. Say their loan amount's $300,000. We take 10% of that amount and say, hey, take $30,000 in cash to pay off bills for only, $214 a month, whatever the payment would be on the cash out. That's a pretty attractive offer when people thinking about, getting 30 grand for $200, $250 a month, pay off credit cards, college loans, cars. We're back to a little bit of a cash out market with some equity in certain states.
Great. Another question, Bill from California says that he has a question in regards to your company and the size of your company versus some of the other competitors out there. Jeff, what is your unique selling proposition from a company standpoint, and how do you compete with some of the bigger direct mail companies out there?
Well, I've worked for direct mail companies that were doing $20 million a year worth of direct mail for the mortgage industry. And, we had, I think, 140 employees at that company in Orange County, California. So I've worked at big companies. This is my company. It's small. I've got 5 full-time employees, between graphic artists, account coordinators, data people, and a couple of salespeople. So I'm pretty small. Only started getting back into this business about 1.5 years ago, so I'm building them. I don't know the benefit of going with a big company or a small one. if you go with a smaller company, one thing I can do for my clients is really protect them. If I get something that's really working for them, I'm not going to go take that and go sell it to 100 other companies in the same areas and saturate the list and hurt their response. Because I'm smaller, I can protect my clients a little bit better. I don't need to do the big volume. So I think, for me, I'm going to give them an overall better deal for being small. I can't think of the reasons why you'd want to go to a bigger company. My costs are pretty similar. I probably charge a few pennies more per piece just to really analyze this data, track the campaign, write custom copy that's going to get a better response rate. So I'm a little bit more expensive than the monster mail shops out there that are down and dirty pricing. But I think you get what you pay for. You definitely get a little bit more working with me in my experience. And when these hot niches come out that are, I can typically bring a nice package of here's the mail piece, here's the list. Fannie Mae just announced these changes for HARP. Let's go after all the May of 2009 Fannie Mae loans and I things to them faster that will get them that quick response rate that they're not getting from their cheap print shop,
Yeah. So it's more about the creativity and the customization and just the mortgage experience that is really the added value, and then the protection value of being able to take a good strategy and give it some legs versus burning it out from overselling it. So when you do have a list, you're not cross-selling that list again and again. That is that particular client's list. The exclusivity is given for a period of time.
Absolutely. Yeah, we were able to do that because we're a little bit smaller. And I have about 100 clients right now, around the country, but there's a lot of data out there, so I'm pretty careful to make sure everybody gets good data and good response.
You've got some large clients, Jeff. Talk a little bit more about some of the larger organizations and kind of volume that they're running through your organization on a monthly basis.
Well, I'll give you a quick example. If you're in California, you've probably heard of the lender, Cash Call. Cash Call, I think in June of this year, funded like 3,000 loans, and they spent $3 million on marketing that month. So it was $1,000 a loan, to get a loan funded off marketing. And it's funny, I don't care if you want 3 loans a month, 300 loans a month, or 3,000 loans a month. It's about $1,000 a loan for marketing, and that's in California where it's a little more competitive. And big lenders like that do TV, radio, internet leads, and direct mail is just a portion of their budget, but it's a pretty big portion. $3 million a month. 500 grand on direct mail, and you don't, just like we talked about diversifying their mortgage company, not just to do refis and to do a little bit of purchase business. You want to diversify your marketing and not have one thing that's the only thing working for you. It's nice to have a few different advertising mediums, because when things change, you want to have a few different things working just in case, post office goes on strike and stops delivering mail, or postage goes way up. You want to have a mix. So, bigger clients, I've got a handful of large clients licensed in, 30 or 40 states that are mailing hundreds of thousands of mailers, and then I've got a lot of medium-sized clients mailing 10, 20, 50,000 pieces a month. So
I want to get to the heat map that you provided, and I want to talk a little bit more about these, how to improve your closing ratio steps, and we'll get to that here in just a moment. But talk to us a little bit about this heat map that we have up on the screen.
Well, because I'm on the distribution list from Fannie Mae, I get updates on different things going on with Fannie, with FHA, with VA, and I'm always looking for these niches where, this is a hot new niche. Let's go get the data and let's design the letter and mail it and generate a bunch of response to close loans. And, this is something that Fannie Mae had on their website, talking about how many loans are still sitting out there that haven't taken advantage of HARP. It's some of the hot spots, Florida, Georgia, Michigan, Illinois. How many loans are still sitting out there that are Fannie Mae owned that are paying, 6-7% interest rates that can refi. Now, a lot of these people don't have the credit score or the income, and that's part of the reason why they haven't refied. So that's another issue we got to contend with. It's not like this is golden eggs here, but again, there's some big opportunity to fund, an extra 100, an extra couple hundred loans, still targeting Fannie Freddie. If we can get the response rate and get it to be profitable, it's a big opportunity.
So this is a letter that you crafted on behalf of one of your clients and got their approval to share this. So talk a little bit more about the letter and walk us through any of the critical elements that we need to be focusing on.
Well, if people are on the call and they know anything about HARP, Fannie Freddie just came out and said, hey, we changed the rule. The loan doesn't have to be purchased by Fannie Freddie, prior to June 1st. As long as the loan recorded prior to June 1st, we're going to allow them to do a HARP loan. Well, that's a big opportunity because there are hundreds of thousands of mortgages from April and May of '09 that didn't qualify before that now qualify. A lot of those people might have called and been turned down because their loan funded in May and they didn't buy it till July. So what we did is came up with a letter real specific to April and May of 2009 and pulling a data set of Fannie Freddie owned mortgages from just those 2 months, and we designed a real specific letter. Again, the list and the offer. Recent changes to HARP will have an effect on your $200,000 loan, with whatever, Countrywide, IndyMac, because your loan recorded in May of '09. So it's all variable data on the letter, real specific list, real specific offer, quoting a low payment, based on today's rates. And, here's the data for all the loans that recorded April and May of '09 throughout the nation. In California, there's 30,000 of them. Colorado, almost 6,000. So when these programs come out, we go in and get the data really quickly, write a good, strong letter to make the phones ring, and little niches that I can bring to clients before everybody else gets to them.
Great. Well, we're going to talk a little bit more about improving your closing ratio, but for those people that were just looking for some ideas on the marketing, I'm going to go ahead and just throw up a quick poll. If you need to jam and can't stick around for this next exciting part about how to improve your closing ratio, go ahead and cast your vote on the poll, and one of Jeff's customer service representatives will follow up with you, and then we'll get into the rest of this presentation. Jeff, in terms of turn times from today with the holidays and just kind of considering the end of the year coming with all the holiday mail, what is the recommendation to get the best response rate and not get too cluttered with all the other holiday Christmas mailing and all that kind of stuff?
Well, we run counts for their states or their counties, their areas, and send them counts for probably the 3 most responsive lists, FHA, VA, HARP, and then we send 2 or 3 letters. And once they pick out letters and what states they want to mail to, it's basically about a week to get something mailed, and depending on what state you're in, a week to a week and a half to get it delivered. So right now we're signing people up saying, hey, let's not have your mail hit, Wednesday before Thanksgiving. That's probably not the best week to have mail delivered. So right now we're putting mailers together that are going to be delivered, Monday right after Thanksgiving, and make those phones ring hard through the end of November, December, and then probably skip, the Christmas week. Right now we just designed a new letter that says the 3 reasons why you should refinance in December. You can skip your December house payment. If you time it right and you record late in December, they might skip or defer 2 house payments and get, a few $1,000s to pay for Christmas. Pay off all your bills for the end of the year, New Year's resolution, get out of debt. Start January of 14 with no credit card debt. So we've got a real specific mailer going out for, why people should go ahead and refinance now, skipping a payment, paying off credit card debt. So again, still real specific copy for that so that things don't slow down too much for the next couple months.
Great. Well, we have some quick marketing steps, and we'll get back to these at the end of the presentation. For those of you that want to stick around, let's talk a little bit more about 7 strategies, Jeff, that you've kind of refined to increase closing ratios on leads. Maybe some of this information is not brand new, but a reminder, or maybe just an enhancement on what's already happening out there. But Jeff, if a company's out there and they've been doing direct mail successfully, what can you really do to help them to increase their closing ratio?
Well, I'm going to share some of this in these slides, but what's amazing to me is, I'll generate 100 inbound phone calls for, ABC Mortgage in San Diego, and they'll take 100 inbound phone calls and close, 18 loans. 18% closing ratio. I'll do the exact same mailer, same data, same day in another area of California, and these guys are calling me saying, we only closed 5 loans out of 100 phone calls, and it's like, the difference of 5% to 18% is huge profitability. So I just think to help encourage them to have a system, these big call centers and managing all these calls and all these loan officers can be, taxing. I mean, it's a lot of work, and if you can put some effort into that and increase your closing ratio by a couple percentage points, you can make, a heck of a lot more money and really grow faster. So this little chart just shows, an average closing ratio on leads about 6%. SEO, internet leads is typically 2-3%, telemarketing 3%, TV, radio 4%, direct mail 6%. But if we really work with systems and improving the closing ratios, I've seen closing ratios go to 10, 15, even 20%, on the quality of these calls, and you can see the difference of selling 6 loans, 12 is the same expense for advertising, make a lot more money.
Well, your first strategy, Jeff, is answer your calls. Sounds pretty simple, but talk to us a little bit more about what you mean by that.
Well, just basic phone coverage. I mean, I would say the average mortgage company doing direct mail doesn't pick up at least 10% of their calls. Some of them it's a lot higher than that. And when I do mailers, a lot of times I use my toll-free numbers and I record all the phone calls, and we'll go in and listen to our clients' phone calls and just see, are they answering their phones? How do the loan officers sound on the phone? Do the loan officers know the mailer went out? Do they realize these are owner-occupied, HARP loans, or are they talking to these non-owners as if they're a, first-time buyer, FHA borrower? I mean, we really, the person answering the calls and what's being said and how the flow is going is so important to making these succeed. We try to, do a little bit of consulting to improve the results for our clients so that they'll come back and reorder. So, different tracking campaigns. I've got a lot of my clients set up where if they miss a phone call on the direct mail campaign, it's a $100 phone call. So if you miss it, it sends an email to you saying, hey, you just missed this call. Here's the guy's caller ID. Here's the phone number to call him back at. So I do a lot of things on the back end monitoring these calls with, missed call reports and emails, and when your call volume's heavy and when you need coverage. Hey, the mailer's going to hit Monday. If you're going to get 20 calls that day, maybe staff up Monday afternoon. So there's a lot that goes into just getting your calls answered. It's amazing to me. And I had the same problem in my mortgage company. I was guilty too. And these are some of the things that I worked on. I remember one year looking at, getting 2,000 phone calls a month into the building and closing 140 loans. If I could take my closing ratio from I think it was 6% up to 7%, if I could just improve my closing ratio by 1%, I would have made an extra $1 million for the year. That's how much it meant to me because we were spending so much and bigger volume. So, anything I can do to help increase the ROI overall, I'm working on that. And this one you're showing the slide, put an expiration date on the leads. One thing that I found is once the loan officer takes a phone call, they think that they own that borrower, whether they sell it or not. So, they take a phone call, they take an app, and maybe they take a while to get back to them, or they lose track, they get busy with something else. So one thing I did at my company was I told these loan officers, listen, you get this lead for a week, and after 7 days, I'm going to take this lead away from you, and I'm going to give it to another loan officer, and if they sell the customer and you didn't, you're going to be embarrassed. So I used a lot of emotions of what salespeople are typically pretty competitive, and used it as kind of a way to increase our closing ratio. So, don't give them the lead and just let them have it forever. Put an expiration date on it and let them know if the appraisal is not ordered by this day or you don't have, income documentation faxed or emailed to you, you're going to lose that lead. And it was amazing what that did. It just put a lot more urgency on the loan officers trying to close the sale and get the commitment. So.
Well, number 3 is doing the whole Jack Welch, the former CEO of GE strategy, where you're firing the bottom percentage group. So talk a little bit more about how that's gone for some of your clients or for your own previous history.
Yeah, so I had loan officers in the building. Some were closing at 19%, and some were closing at 1%. And if you didn't know what was going on, and the guy that's closing 10, 15 loans a month, he's so busy, or she, that what would happen was that my best closers would get so busy with loans in their pipeline that they wouldn't be available for new phone calls. So the person that would end up taking the most phone calls in the office would always be my worst closer. So it's kind of like a double whammy. I mean, they're taking all the calls and they can't convert and close. So I was always watching that closely to where I just always got rid of the bottom. If you can't convert at a decent, profitable level, you've got to get them out. And what I've learned is, I would say out of 100 loan officers that have been in the business for 5 years or longer, probably only 25 of them can take an incoming call from direct mail, build rapport, and close a loan over the telephone. The other 75% just aren't good at it. They can't do it. They're used to working with realtors and getting referred to all their borrowers. They're not used to selling. There's some really good loan officers out there that know how to do loans, but they really don't have the selling skills or the rapport building skills to be able to close leads over the phone. And one really good interview question is, role playing like you're a borrower. I just got 3 letters in the mail this week, all with, different offers. Why should I do my loan with you? And see if they can build rapport and sell over the phone, because not everybody can. So.
Great. Well, number 4 is a letter from the president with the last name Bush. Maybe that comes off better, but talk a little bit more about how you've used this.
Yeah, it didn't go too well in Hawaii. They didn't like President Bush too much, or South Florida. But yeah, it was kind of funny because when people got this letter in the mail, they would call and say, "Is there really a Jeff Bush there that's the president of direct funding?" They thought it was a joke, but it was kind of funny. Anyways, and that was what, back in 2000 to whatever, to 07. So anyways, every phone call we got, I would mail a letter to these people and just make sure that they got the information that they needed. And I was blown away how many phone calls I got saying, "I called your office, gave them my security number. They were supposed to get back to me, and I never heard from them." And it was so upsetting. And once the loan officers knew that these letters were going out and that I was getting them back, or I was getting phone calls of borrowers saying, "Hey, no one ever got back to me and quoted me a loan or told me anything about what they found on my credit report," it kind of woke up a lot of loan officers. And just the fact that they knew I was doing this, it held them a little bit more accountable to working these leads, calling people back in a timely fashion, which of course improves your closing ratio. It's all kind of, so a real simple letter. I call it the letter from the president. Unfortunately, I got a real big response on this letter. Want to make sure we could answer all your questions, the information. Again, it's not one thing, but all these little things that I was working on to try to improve my closing ratio by maybe 1% was, it's all part of it,
Great. Well, we're going to take some questions from the participants, and so if you have a question, we're going to leave some time at the end of the presentation. We've got 3 more strategies that Jeff is going to talk about, and then if you have a question about your closing ratio or your direct mail, please go ahead and submit that using the control panel over there on the right-hand side of your screen, and we'll answer those in the order in which they were received. Jeff, number 5 is scheduling a follow-up call 2 weeks out.
Yeah, I was just thinking to myself, I was closing 140 loans a month with no CRM system. My CRM system was Calyx Point. It was a joke. We used the conversation log to log everything, but it ended up working for us where we would go into our little, Calyx Point and say, "Hey, every 2 weeks we're going to schedule a follow-up call to call these people back." It was amazing how many people that called in, kind of spur of the moment, called from their cell phone, driving to work. They weren't really ready to talk about their mortgage at that time, but 2 weeks later, they were a lot more open to it. Maybe, different things that happen in life. So these leads are sometimes just as warm 2 weeks later as they are the first day they call. So we would always just schedule a call, and you can do it in your CRM nowadays and make it a lot more efficient than what I had. But, call them in 2 weeks and just make sure there's at least one follow-up call to these borrowers 2 weeks later, to pick up some low-hanging fruit that's still out there that, again, loan officer didn't call them back, or they left a message, never called them back. There's just another way to improve your closing ratio.
You've used the listening to phone calls, the recorded phone system that you offer as an option to all of your direct mail clients as a sales training tool. Talk a little bit more about how you've used that and how others have been able to improve the performance of their team just simply by having this extra feature.
Yeah, so we would record all the phone calls that came in the building and listen to them consistently, especially if we had a loan officer that didn't have many loans in their pipeline and they were taking a lot of calls. We'd try to figure out what was going on. And playing the phone calls, I mean, it would churn your stomach sometimes, listening to how these calls would go down. And sometimes some quick little coaching would help these loan officers improve their closing ratio. Like they'd go from closing 2% of their calls to 10% just with some basic training on phone etiquette and getting the person's name and phone number to call them back. So listening to phone calls is just crucial to improving your conversion ratio on calls. One thing I used to do is I would record these phone calls. We'd go into a sales meeting. I think I had 30 loan officers at one time, and we'd put the loan officers in a room and we'd start playing their phone calls in front of all their peers. Oh my gosh, once I started doing that, they really wanted to make sure that they were good on the phone and that they did what they were supposed to do, knowing that their peers were going to hear their phone call in the sales room. I actually had one loan officer member get so upset and cry and quit just because they were so embarrassed of how bad they choked the call in front of their peers, but it really got them on point to where, they picked up their conversation and did what they were supposed to do. So I think that's a powerful tool.
Well, as we wrap up here, there's some other questions coming in, but talk a little bit more about the rework team, Jeff, and then we'll take these questions.
Yeah, just, if you have a big group of loan officers and they're taking all the calls, having 2 people dedicated to reworking old leads, I think there's a lot of loans still sitting out there from these calls that have come in. So we'd have like a rework team that would wait maybe 30 days after the phone call came in, and they would come in behind the loan officer and try to, a different voice on the phone, switching it from a man to a woman. It was amazing the difference. And, sometimes selling loans is just a connection of trust with that borrower. And if the loan officer that originally took the call didn't establish trust and some rapport, or just had the wrong personality or the wrong voice, I knew rework teams that would close, 30 or 40 extra loans a month with just a couple people reworking the same leads. You pay $100 for these phone calls. Just, get $100 out of it and put $100 with effort into it. So rework team can really increase the, again, the closing ratio on leads, just calling them 30 days later.
Great. Well, first question, Jeff, is how to maximize from every door direct mail. Can you explain a little bit more about that?
So every door direct mail, that was a question from one of the big mailers out there. Basically, the post office says, hey, if you mail everybody in a zip code or a carrier route, we're going to take your postage from like 28 cents a piece down to, I think it's around 15 cents. So how to maximize it? Every door direct mail is basically just a saturation mailer where you're mailing everybody in a particular zip code. You don't know anything about their loan. You don't know if they're a homeowner or a renter or an FHA or a HARP or what loan date they funded, how big their loan is. Saturation mailers, I'm not a huge fan of them because you can't target. You don't know who you're mailing and you don't know what to offer. And again, direct mail success is all about the list and the offer. So, it's basically attractive because it's cheap. So instead of spending, let's say, 60 cents a piece on a mailer, you take 15 cents off your postage, you can pay 45 cents, saturate an area, and you can do a lot more direct mail, a lot more quantity. But I don't know if you'll ever get your cost per funded loan down by mailing a generic list with a real generic offer. I imagine there's a way to make it work. I know some big solar companies that I do direct mail for, they saturate neighborhoods for solar offers. It's not as important as using their mortgage amount and quoting a payment and all the things we do in direct mail to make the response rate go up and conversion go up. So I know some companies have been successful with it, but I don't know if I'd suggest it for a mortgage company doing refis. If they have a different offer, like, you could saturate an apartment complex for a purchase offer, I guess that would make sense. Three-door direct mail is just the post office getting the postage down by saturating and doing quantity instead of quality.
Next question is it has to do with this special offer that you've thrown out there, just in terms of finding the right people to be the closers in your organization. Is there any interviewing or recruiting tactics that you could share, Jeff, based on your and hiring as many people as you've hired over the years, what are specific things that you look for?
You know, I used to use the DISC sales profile for hiring all my loan officers, and I never hired not one loan officer that didn't complete my DISC profile. And if you're familiar with it, you know, you've got 4 different personality types. D is like driven, I is like influencer, S is steady, and C is conscientious. So my experience was if these loan officers did not have some high D or high I on my profile, they really couldn't sell. I mean, they might be a great loan officer working on referrals because they knew debt ratios. You know, the S being steady, that's more of like a receptionist type position. The C is kind of like an engineer, accountant, kind of analytical. And some really good loan officers are high C personalities, but it's very hard for them to build rapport and close over the telephone. So in my world, you know, if they didn't score high on my DISC profile with some drive and influence, I just wouldn't hire them to take incoming phone calls because I just knew their closing ratio was going to be weak. I have a good friend that sells the DISC profiles. If somebody wanted to take a look at that, they could shoot me an email and I'll put them in touch with a friend of mine that did all this for me. So personality profile was big. You know, the interview questions, just figuring they have to sell through a lot of competition on leads, and they've got to be able to explain why somebody should use them instead of someone else. Can they build rapport and trust over the telephone, and do they ask for the order? Are they salespeople? You know, these leads obviously are not all laydowns. They need to be worked, and they need to be closed. So I only hired salespeople to take incoming calls. Some of my best loan officers that were really good at doing loans, they couldn't take an incoming call and close it. Even though they were good with realtors and referrals, it's a totally different person in my opinion. So
that's great. Well, Jeff, you've given us a lot of added value to the marketing strategies that you've shared, and I think that that's the uniqueness that you bring to the marketplace of people that are looking to enhance their response rates and improve their organization and their closing ratio as well. So thanks for your time today. If you're ready to start marketing or would like to continue the conversation with Jeff or one of his service representatives, you can call 800-784-5194, or you can email Jeff directly at jeffbush@overflowworks.com. Jeff, any final comments before we close the webinar today?
No, if you're interested in marketing or closing ratio or any of this stuff, I mean, you could shoot me an email and we can set up a conference call. I'd love to spend time on the phone with you, or if you're in California, I'll come out and visit you. I'm in Temecula, California area, Murrieta, but near Temecula. So I'd love to connect with you with a conference call and just discuss if there's a way I can help you in any way. That'd be great.
Great. Well, thanks everybody for the time today, and thanks, Jeff, for your expertise, and we look forward to having each and every one of you on one of our upcoming webinars in the future. On behalf of Overflowworks, I'm David Bush, wishing you all a great day.